Market structure. When we talk about market structure, we are talking about the price structure and the way the market moves and how moves interact with each other to form cycles. Market structure shows us the foundational direction of the market. All market trends start and end with a fractal. Whether it is an impulse move or a correction, the move will always begin and end with a fractal. As a bull market moves higher, it breaks bull fractals, and as a bear market moves lower, it breaks bear fractals. So within a trend, we have impulse moves and corrective moves, which make up the basic structure of a trend. Impulse moves are moves in the direction of the primary trend, and corrective moves are counter trend moves against the primary trend. When we have a corrective move or a correction in a bull market, we break the immediate market structure. In a bull market, the farther price stretches, so when price is overextended, less buyers want to join into the move. So after some time, whoever wants to buy or wanted to buy has already bought, and those who feel that it's too extended are either are waiting for a retracement to buy, or they're looking for a chance to short the move. So sellers will start testing the strength of the move at a point where they feel that the buying strength is weak enough to be turned, and as the sellers join the fight, traders who are long will see the upward momentum drop, and some will sell out, which adds to the downward momentum. Counter trend players seeing the start of the retracement will also start shorting, contributing to the supply and facilitating a market structure, a market correction. So basically that's how you have a market correction, just the way that I just said about the market being overextended. So you're in a bull market and the market's overextended. After it gets so far, that's when new buyers don't want to jump into the market, and then you get some sellers who think that the market's going to drop. Therefore, they start jumping into the market, and that causes the correction. So to understand a trend, we'll learn the basic Dow theory, which is a concept credited to Charles Dow. The Dow theory is a methodology to determine the actual strength of a market. We'll learn how to identify the primary or main trends as explained by the Dow theory. According to the Dow theory, a trend consists of three categories: your primary, secondary, and minor trends. Our goal will be to identify the primary trend and trade that trend direction on a smaller time frame. So the primary trend, a primary trend also known as the main trend in a bull market, is identified by a series of higher bull fractals and higher bear fractals. The trend remains in force for a year to a few years. For a bear market, price forms lower bull fractals and lower bear fractals. All other things remain the same. So the primary trend is the direction of highest probability, and following the primary trend keeps you in high probability trades. A longer time frame gives some good indication about price movement as opposed to the shorter time frames, which contain a lot of noise and false moves. The primary trend is identified in the longer time frame chart called the primary chart, and then a selected time frame by the trader is used to identify the setup and entries called the trade chart or the setup chart. Now it says we're going to look for the primary trend, and primary trends usually last for years, a year to a few years. We're not going to basically trade that primary trend. You'll catch on as we move on and look at things. So here you see the US dollar CAD on a 4-year primary trend. You can see where it started back here, 7/26/2011, and it ended 1/20/2016. That's your primary trend. That's the main direction that you really wanted to be trading this market at that time. So primary and trading chart time frame. So basically looking at a monthly primary chart, that's your primary trend. The primary trend will be recognized with monthly charts, and the weekly charts can be used to identify the setups and entries. So therefore you can see the time frames I have listed. I have the weekly primary chart, which would be the primary trend will be considered the weekly charts, and the daily charts can be used to identify your setups and entries. Now basically I'm going to be using the daily primary charts and the 4-hour primary chart. I won't probably ever go this much lower to the hourly primary and the 5-minute primary and all that. So with the daily primary chart, the primary trend will be recognized with the daily charts, and the H4 chart can be used to identify the setups and entries. And then the same thing with your H4, you could use that as your primary trend, and you'll recognize your 1-hour chart as the setup and entries chart. So here you can see a primary monthly chart for a trend direction and support and resistance levels. So here's your monthly chart, and you can see you set up your support and resistance levels. You can see I have Nice little trend line there, but basically we're not looking at that. We're just looking at the primary trend on a monthly time frame. And then you're going to use your weekly chart for your setups and entries. So you will drop down to a weekly. After you determine your direction with the monthly, then you'll get into the weekly chart and you'll trade that direction. Now you can trade the reverse direction, but you need to know that you're trading a counter trend move or a pullback. So here you see your weekly primary chart. As then you're using your daily chart for the setups. And then again your daily primary chart. And then your H4 as your setup chart. Alright, so trading time frames will be a personal choice for each trader. So one thing you must keep in mind is that there is noise in a shorter time frame chart that can distract you and cause confusion. So if you want to be in a high probability opportunities, it's important to remember that the larger time frame tells the whole picture of the market. Trading on a 1 hour chart, you really have 1/24th of the true information. Even smaller time frames will be even less informative, okay? So let's go to the charts and look at the primary trend on each time frame so we can see the concept of trading two time frames in action. All right, so we're going to use the live charts to look over the time frames that you're going to use for your primary and your trading charts. But before I do that, I want to touch on something that we talked about when we looked at inside trading and trading in the box. Basically, I'm going to show you some inside trading that's happening right now on the daily time frame of the US dollar CAD. So we're looking at this right here, and I'm going to change this because I want to make this border red and make the inside yellow. Keep the border a little thicker, keep that as our default, and okay. But looking at this, you can see we have this candle here, so I'm going to move the box out the way. This is the mother candle, because you have this candle trading inside of this mother candle. So when we just look at that, you could see what I'm looking at. Just these two candles are inside of each other, but then we have this candle that's inside. Now the wick broke above, but you could see one thing that's really important here. And then I'm going to the next candle too. It's still inside of that candle. So I'm waiting for the market to break above or below this level. And the way the market is going now, we're breaking bull fractals, right? So we're breaking bull fractals. So we should break another bull fractal. So I'm going to be looking for the market to break above this level here and close above that level. If it closes below, I still know that it has to break this fractal here to change the structure, and the market could come all the way down to this level before violating structure right there. So let's make those red. All right. But then another thing that I want to show you really quickly, so I just wanted to touch on showing you this because I see it happening right now live, but the market never violated this high here. Well, this where the market closed here. So we opened here, then made a low, then went higher, made a new high, but then we closed here. So let's look at that close. We never violated this close. I'm going to make a line right at that close. Alright, so we never really violated that close. You could see we're a little bit above that level, but we're pretty much in that area. You could see at this high here, we made a close here, then we opened and closed down here, and then we kind of closed a little bit above that level, and then we're opening above that level. We need to see a close above this point here, and that would set our trade to the upside if we're following the market to the upside with the bull fractals. So that's one thing, looking at the inside trading, and then breaking outside to trade your to make your trade. But we'll be talking about that and looking at the market more when we talk about putting it all together. I'm going to show you how to put all of this stuff together that we're talking about from the first video all the way through till the very end, and then we'll cover the market psychology and get your mental side right, and then you should be a very defined technical trader and have some mental strength behind you. All right, but let's go to first the monthly time frame. So if I have the monthly, I'm looking at the monthly primary trend. The monthly primary trend is to the upside, right? So we could see that this is to the upside. But then the immediate trend, we started breaking these fractals here. We broke this first bull fractal. So I'm going to take that into effect when I start trading, looking at my next chart, which is going to be my trade chart, which will be my weekly time frame. All right, so I go from the monthly, and I know the direction I wanted to trade, but I'm also going to take into effect, now we broke a bull fractal. All right, so let's remove these. We broke a bear fractal, sorry. So this break of this bear fractal may signify the change of this primary trend. All along we were looking at this primary trend to the upside here and never really looking at trading to the downside, but a break below this fractal here has changed what our mentality may be. So we may see a fractal up in this area and then the market continue to the downside. But if I'm looking at my monthly, I want to use my weekly to trade with. So you could see the weekly broke a bear fractal here. So that's going to be a big sign here. So you have to learn how to put these signs together each time frame that you're trading with. So we'll get deeper into this, but the thing is, once we already broke a fractal on the monthly, that could signify what we're going to be doing for the weekly. So let's change this, because this is right here is the start of the change of structure. So all along the structure was bullish. Now we may be getting a change here, which will signify bearish. So the bearish structure started on the lower time frame, but it signified a move here on the higher time frame. So we go down to our weekly, and you can see here's where it signified and really broke to the downside. So here, if we traded just what we saw from our weekly chart, we would trade the break of this fractal here and trade to the downside. All right, and the market moved to the downside. But here's where our signal is for the weekly, for the whole primary chart off of the monthly time frame. Now we could see, now we would be looking for a setup to the downside. So we would be looking for our entry off of one of this, something more like this, inside trading again. So we could look at an inside trade here, and then the market drops to the downside, we trade. If it closes above, then we just disregard it. All right, so that's looking at the weekly and the monthly. The monthly is your primary, and then the weekly is your trading chart. Now we have the weekly, and we see that we broke a bear fractal here, but this overall structure, the market was bullish. Now we have a break here, so now we're going to look at the daily. So our weekly is our primary trend, then the daily is going to be our trading chart. So if we looked at that weekly where we saw that break, let's go back to the weekly. We're going to pay attention to the primary trend, but we also want to see what the immediate trend is and what the immediate action is in the market. So we broke a bear fractal here. Basically, I'm going to put it at this level because this is the real bear fractal. This is inside the move. All right, so then we're going to go to our daily, and now we're late, but you could see this is where we would start looking to trade with the immediate trend of the weekly time frame, and we had a break of a fractal here, and then the market pulled back. You get your pullback levels. Once we start learning how to put it all together, you'll look for where your levels are and you'll trade to the downside. Already had that fractal break to signify the first move to the downside. Now here we would have been looking for like maybe the 1, 2, 3 correction or continuation, but we'll get even deeper into that once we start talking about everything. So let's go to look at the time frames again. So this is your daily time frame. If you were using the daily as your primary trend, so I would be looking at this primary trend here, and then I would use my 4-hour time frame to trade with. So back to the daily, when I looked at that daily structure and we see the break of the fractal here, and now we know that this trend may be ending. Now our primary trend may be coming bullish, so I'm going to mark that. We look here, and you're going to learn about fractals bouncing back on fractal levels. But let's go to the 4-hour and see where that break was based off of the daily. So here's where the daily structure changed right here. Now the 4-hour structure changed back here, so you get an earlier view, but the daily, to be in line with what the daily was doing, this was the break here, and then the market continued to the upside. So you would trade this move here. All right, so that's looking at the 4-hour. So now we're looking at the 4-hour primary trend, and we could look at the immediate trend here. You could see this 4-hour trend, and now we're going to go to a 1-hour chart, and I'm not going to go any lower than that. So we would trade with the 1-hour chart. So we want to trade the direction of the 4-hour trend. Now this gets a little sloppy to me when you start getting a little bit lower time frames, and you got to look it over well. But let's go back to the 4-hour. So here's my 4-hour. You could see we're bullish from this point. You had some pullbacks, but overall we're bullish. All right, so the market's moving to the upside. Let's mark it. Moving to the upside here. So then we go to the hourly, and we trade that move to the upside. So we're going to try to trade everything to the upside. All right, so you wouldn't trade pretty much the corrections. Let's go back to the 4-hour. So 4-hour, you could see the primary moves, and then these little corrections, and primary move, then a correction. So you have your impulse and then your correction. I'm going to draw it really quickly down here. So you got your move, then your correction, then your move, then your correction, then your move, correction, your move, and then we kind of flattened out here. This is where you start to look, and you could see the market didn't violate these fractal levels, and then the first fractal level break was here. So that changed the structure temporarily, but we knew that the overall break, when you go back and look at it, this changed the structure here. So we could have traded this downside move here with the break of the 4-hour structure, because that's our primary chart. All right, and then we go back and look. Now we started breaking bull fractals again. All right, and we're not breaking any bear fractals. And so far, no bear fractal breaks, so we're looking at bull fractals. And the market's not doing much right now in this period here. So when we went back to our 4-hour time frame, we would trade with the move here. So let me erase this and then try to show you something really quick. So here's where that structure changed for the 4-hour, and we're going to go to the 1-hour. I'm going to mark that structure change, and then I'm going to mark this so we could see that whole move. That whole move was basically right here. So this is where the move to the downside started. All right, because your primary was to the upside, then we had a big correction. Because see, you broke here, and then you had this bigger correction. So when you went down to your 1-hour, you would see that. And here's the break here, and then the market moved to the downside. Now really, if we know we're following this trend here, we really don't want to trade this. But this is going to be a big trend change, and then you take that trade. But the thing about it is you're trading against your primary basically. So what you're looking at when you're trading against that primary, you're counter trend trading. We really don't want to trade that, but that was a really good move here. But then you could see the market gets right back in a line with this overall trend. It's hard to break this overall trend just that quick, and the market will flatten out like this before it breaks an overall trend and moves to the downside. Now it didn't break the overall trend, and it got back in line with the primary, and you could see we're still moving to the upside. Now when I start looking, when we start talking more about support and resistance, we'll try to find the level where that primary trend may break. So we're going to have our support and resistance levels, and we're going to see if that primary trend can violate those levels. And if it doesn't, then continues to the downside, maybe we have a start of a new primary trend. All right, but we're going to have so many clues as we started already talking about. We already talked about fractals. We already talked about the market structure. Fractals are going to be big, all right, and just looking at the overall market. And then once we put our support and resistance levels in, you're going to have all the tools you need to really see and understand when the market's changing structure and when a new primary trend may be developing. And again, we don't know if it's a primary trend. This could have developed into a primary trend. Let me show you this here. Let's remove this. This could have developed into a primary trend, all right, because what could happen if we're looking at this, let's go back to the 4-hour, because that's where we're going to look at that's going to work where we're getting our primary. That's going to be our primary. So our primary is here. So the primary trend is to the upside, but then we flattened out here. So when we flatten out, that's how the market changes direction for a major move. But we flattened out here and then we came back down to the downside. A little correction here. Looks bigger than it is if you have your chart extended like this, but it's really not that big. But we don't know if this is going to be a correction or a change to move into a new primary trend, because what could happen is this. The market goes down, comes up, goes down, and then now we probably have a new primary trend. But instead it did this. It's going this way. Right? So it's continuing with this primary trend. So we never know until we really get into a big trend that it's a primary. Right? But primary trends based off of what time frame you're trading. If you look at a daily time frame trend and weekly and monthly, you'll know if it's a long-term trend or if it's a correction. All right, because basically they last for over a year or more. All right, so you'll know what that is. All right, but that's it. So let's continue with looking at the market structure. All right, guys, so we now know what a primary trend looks like, but let's look at the framework which supports a trend. So based on the Elliott wave theory, a trend is comprised of impulse and corrective waves, which create the overall structure of the trend. So these waves are the underlying cycles of the primary trend. An impulse wave is a sustained move in the direction of the primary trend. So if the primary trend is bullish, then the impulse waves are also bullish, and if the primary trend is bearish, then the impulse waves are also bearish, and therefore moving in the direction of the primary trend. An impulse wave in a bullish trend represents the start of the accumulation phase of the trend. So you'll see better as I give you examples of this. The accumulation phase is when buyers are entering the market. With every start of a new bullish impulse wave, this represents a new accumulation phase that has just started and the end of a downtrend. An impulse wave in a bear trend represents the start of the distribution phase of the trend. So distribution occurs when sellers enter the market, and distribution phase in the distribution phase market the end of an uptrend and the start of a downtrend. So the distribution phase marks the end of an uptrend and the start of the downtrend. It is very important to know these waves and what it takes place during that time to help you to understand how to get into a higher probability trade setup. And you'll be following the strength of the market if you are in a high probability trade setup based off of the things that we're just talking about. All right, so first let's look at the accumulation phase and understand that. So the diagram below represents a bullish trend. The white lines are impulse waves which go with the trend, so they follow the main direction of the trend, and the black lines represent corrections going against the trend or counter trend. So with the end of a correction starts the accumulation phase. This is the phase we're looking at right now that we want to understand. So this is the phase where buyers are entering into the market, pushing the market higher and starting a new impulse wave. So basically, let's start from the impulse wave. You have a correction, and then at that correction, when the market falls to the lowest level where more buyers come into the market, which will be your accumulation phase, that starts your new impulse wave. Then you have a correction again, and then at the end of that correction is your accumulation phase, and then you have an impulse wave that starts with after the accumulation phase. So the distribution phase is a little bit different. It's the same, but in a different way. So here you can see the main trend is now bearish, and the trend to the downside is bearish. So the end of the correction in a bear market starts the distribution phase where sellers are entering into the market, pushing the market lower and starting a new impulse wave. So you can see this is the distribution phase. This is where more sellers jump into the market and push this market lower. And that's the direction we want to go. Therefore, at the bottom of the impulse wave, where we get our correction, will be the accumulation phase. Starts the correction. And the distribution phase ends the correction and starts the impulse wave. And then the accumulation phase ends the impulse wave, starts the correction. And then the distribution phase again ends the correction, starts the impulse wave. All right. So looking at a primary trend, based on the structure, you have your impulse wave, then you have your correction, you have your impulse wave, correction, and then impulse wave. And with that, your impulse wave, you have your distribution phase at the top here that starts the correction. Then you have your impulse wave with your distribution phase again that starts the correction. Here you have your impulse wave, correction, impulse wave, correction, right? Impulse wave, accumulation phase, correction. Impulse wave, accumulation phase, correction. So in accumulation phase, buyers are coming into the market. Accumulation phase, buyers are coming into the market. All right, so we just need to understand that, but we don't need to really know that much because it's just the direction we want to know, and we do want to know if we're in an impulse wave or a correction. That's going to be the main thing. You don't have to really know the accumulation and distribution phase, but it's good to know what's going on with the market. Therefore, that'll help you to understand what you're doing when you take your trades. All right, so we're going to start talking about fractals, because if we're talking about price structure, then we have to talk about fractals. Fractals are basically a map for the market structure. So if the map of the market structure will guide us, then it only makes sense for us to use the fractals in our trading, right? So basically the fractals are a map of the market structure, and we need to understand how to follow the market structure based off of that map with the fractals. But before we can let them guide us, we need to know what they are. Okay, so on a bull fractal, there must be one bar that has a higher high than the two preceding bars and a higher high than the two following bars. So for a bear fractal, there must be one bar that has a lower low than the two preceding bars and a lower low than the two following bars. And I know I'm reading and saying a lot here, but you'll see as we show little examples here. If any of the two preceding or following candles high is equal to or beyond the middle candle, then the formation is not valid. The two bars preceding or following the fractal can be equal to each other or in any order, just as long as they're not equal to or higher than the fractal bar, which would be that middle bar. So once a fractal is formed, it remains a fractal and does not repaint. Fractals are developed with a minimum of 5 bars. You can have more than 5, but 5 is the minimum. Some charting packages allow fractals with 3 bars, but studying from Bill Williams' theory, which is how I understand and learn this, 5 is the minimum. A trend starts with a fractal and it ends with a fractal. That concept alone is a vital piece of information that many traders fail to take notice of. All right, so let's look at what a fractal is. Let's look at a bull fractal here. Here's the middle bar. You got two before it and 2 after it. The 2 before it have 2 lower highs before it. Then the bull fractal has the highest high, and then the 2 after it have 2 lower highs. This high is lower than this fractal high. This high and this high is lower than this fractal high here. That's a bull fractal. A bear fractal would have opposite. It would be to the downside, where you have 2 higher lows before the fractal and 2 higher lows after the fractal. So here's the low of the fractal, and these 2 lows are higher than that fractal. And these 2 lows after the fractal are higher. So basically the 5, you can see the 5 there, the 5 bars. And then your trends start with a fractal, your trend ends with the fractal. You could see that fractal started the trend and it ended the trend. So the simplest element of market structure is fractals. Fractals alone are highly important in your market analysis. Fractals will lead you to the direction of highest probability, and that is a fact. When the market is in a bullish trend, the market makes bull fractals and bear fractals. At the start of a bull primary trend, the market makes a bear fractal starting the accumulation phase. All right, so the accumulation phase we talked about, the market makes a bear fractal, and that starts the accumulation phase. All right, and then the market proceeds higher, and you'll see this in examples as we go on. In most cases, while the market is moving higher, we will not break any bear fractals, even during distribution. Okay, so normally when the trend is moving up or down, whichever way that trend is going, normally we won't break fractals. We'll break fractals the direction of the trend. So simply, in a bull market, the market breaks bull fractals, and we should be bulls. In a bear market, the market breaks bear fractals, and we should be bears. Following this concept alone, just that concept that I just said, let's go over that again. So, simply put, in a bull market, the market is breaking bull fractals. In a bear market, the market is breaking bear fractals. If you follow the direction of the breaks, then you should be safe most of the time. Not all of the time, but most of the time. And that's what we're shooting for, high probability trades. So following that concept alone, again, will no doubt put you in the highest probability trading direction. Now there are exceptions, as nothing's 100% guaranteed, and you guys know this. This concept might fail when there's a major news event which can change the structure of the market temporarily. When the prevailing trend is weakening, we may see this concept fail also. During a ranging market, this concept will fail depending on the size of the range and the time frame being traded. So now we need to understand what is meant by breaking a bull or bear fractal. So let's see what we are talking about. All right, so here's a bear trend. You can see this is a small bear trend. Then you have your accumulation phase at the bottom of the bear trend. All right, so then at the bottom of the trend where you have your accumulation phase, you have one bull fractal here. This candle violated the bull fractal. This big candle violated that bull fractal level right there. So the close above this level is the violation, not just the move above it. The close above it is the violation. So with the violation of this first bull fractal, this represents loss of momentum and buying pressure and first signs of change in structure. We're always looking for that first fractal break on a trend. All right, so when the market's trending to the downside here, you're breaking these bear fractals. You haven't broken this bull fractal, you broke this bear fractal here. And then you came down and you accumulated, and then you broke a bull fractal. That starts to move to the upside. You should be trading to the upside. The market violated this bull fractal, and then again it violated another bull fractal. Close above that bull fractal level right here, and that's a violation. So now, as we see, the market continues to move higher based off of what we said. Follow the fractal breaks. And then now, if you didn't catch this one nor this one, you could see that there's another one, a third one, where you have a bull fractal break. This candle right here violates the bull fractal. Close above that level is the violation. You could see we started from here. The market moved higher in a bull trend. We're breaking bull fractals, guys. Never trade short. Why would you trade short when this is showing you the break of bull fractals and the market continuing to go that way? All right. So with that bull market, the bull trend must end somewhere. So where it starts to end becomes your distribution phase, where we have more sellers jumping into the market. All right, and then with that distribution phase, you can see this first bear fractal break starts to change in the market structure from bullish to bearish. So basically we had all these fractals here. This is where we had, you could call this your distribution area, but basically here, depending on the trend prior to this, this could be just a range or, you know, consolidation. But then you had a fractal break right here. A close below this level is a bear fractal break. That's a fractal break when it closes below. This candle violated the bear fractal right here. That's a close below. You should be trading to the downside. With that break, you could see, let's go back. We broke this fractal first. All right. Therefore, we should be trading to the downside if we follow that concept. Now we break another bear fractal. You could see the level where it was violated with this candle here. This candle violated the bear fractal right here. The market's moving to the downside. We should be trading to the downside. All right. There you go. The market violates another bear fractal. That's your bear fractal violation. You want to be trading to the downside. There's no reason to trade to the upside. Look at your fractals. You're not breaking any of the bull fractals. You should be breaking bear fractals and trading to the downside. All right. So let's look at a 3-month bull trend and no bear fractal violations at all. Okay, so when the trend started right here, on 10/15/2015 with a bear fractal, and then 3-month trend, no bear fractal break. There's a bear fractal, there's the next one, next one, next one, next one. Therefore, if you follow the structure in the break of the bull fractals, you should be safe all the time. And then you could see the market goes to the upside. Here's 2 more bear fractals, never violated them, but we are violating bull fractals. All right, and then the market ends up here on 120 in 2016 with a bear fractal. Started with a bear fractal, ended with a bull fractal. Sorry, that's a bull fractal. Started with a bear fractal, ended with a bull fractal, and we did not violate that level. And then we'll see what the market does from that point on. Now here's a 4-month bear trend and no bull fractal violations, guys. This is why I'm telling you that it's so important to follow the map. The map of the market is the basic structure, and that structure is determined by these fractal breaks, by the impulse and corrective waves. All right, and then you could see this is a bull fractal, another bull fractal, another, and another. And then you can see every one that I have been pointing to in this trend never violated any of those fractals. Therefore, you should be trading to the downside because we're violating these bear fractals all through here. All right, this trend started with a bear fractal and ended with a bull fractal. This trend started, guys, sorry, with a bull fractal and ended with a bear fractal. All right, so the downward trend started with this bear fractal and started with this bull fractal and ended with this bear fractal. I'm sorry I'm messing up for you guys, but basically you understand what I'm showing you here once again, so I can make sure there's no confusion here. This trend started, it's a bear trend. It started with this fractal first, which is a bull fractal. Sorry, this bull fractal was not violated. The trend started to the downside. This trend ended with this bear fractal. This bear fractal was not violated. The market went to the upside, violating bull fractals. Started the first bull fractal violation right there. Again, the trend starts and ends with the fractal. And then I showed you the first daily fractal break. And the daily fractal is going to be the main fractal that you want to consider, because you will break a 4-hour fractal, but you may never break that daily fractal. All right, and that daily fractal is going to be the main direction that we want to follow. So this is the first break of any daily bull fractal, and the break changed the structure of the market from bearish to short-term and possibly long-term bullish. All right, we do not know how long the structure will stay bullish, but the first break of the fractal should be a significant event for traders. This represents a possible long-term trend, and now we know which direction we should be trading. These little clues are what we need to defeat the markets. Knowing which direction to trade is half the battle. So therefore, these fractals will give you a big jump on understanding and beating the market. Again, your trend starts and ends with a fractal. Your first fractal break changed the structure right here. First bull fractal break changed the structure of this bear market. And when it changed that structure, the market started going to the upside. You could see we violated, and now we violated another bull fractal. So first we violated this bull fractal, made another bull fractal, and we violated it. Definite sign that the market's going to the upside now. All right. So the bullish trend structure consists of bull fractal violations. Impulse waves should be larger than corrections. Impulse waves should last longer than corrections, and also move farther than a correction. As the corrections become larger, this indicates the weakening of the trend and loss of momentum. So we can understand who is in control of the market, either bears or bulls, from comparing the impulse waves to the correction. In a bull market, if buyers are in control and feel confident about the asset, we'll see small corrections, and if buyers are not as confident and in control, we'll see large corrections. This is often a signal approaching that the market structure is changing. So we'll look at a bear market and notice how the fractal distance shortens as the bull fractals get closer and close as the momentum of the trend weakens, and eventually we have a reversal. As the bull fractals are getting closer, this represents weakening impulse waves and strengthening corrections, which is a sign of increased buying pressure and stronger demand. So I've said a lot, but I'm going to show you a lot. So basically you can see with the illustration below that as the momentum of the market gets stronger, so does the distance between the bull fractals. But as the momentum weakens, so does the distance between the bull fractals until eventually the market breaks a bull fractal and the momentum changes along with the market structure. As you can see, these fractal breaks here, basically these are your fractals, your bear fractals. The market's getting farther apart, making more distance from bear fractal to bear fractal. 130 pips to that, 140 to this, 150 to here. And then it started slowing down 14.7 and finally we broke a bull fractal. Alright, so that shows you that distance means a lot. Alright, so that's going to be fractals and impulse waves. So we now should see how fractals help us to trade in the direction of highest probability. But fractals can also warn us of a market that is in a range. So when the market is ranging or consolidating, there will be clusters of fractals at support or resistance areas. This is the basic structure of a ranging market. The fractals also give us a level of support and resistance, which we'll cover in our next module, support and resistance. But here you can see you have a cluster of fractals, which makes this little range area here. Clusters of fractals equals the range. You can see all these clustered fractals made a range. Same thing here with all the areas grayed in. So we need to look at the market one candle at a time, all right, and then expand on that. So we looked at the market from a bird's eye view, and now we'll become more specific as we look at each candle. And when looking at each candle, we can get an idea of the immediate market sentiment based on candle size and also the size of the wicks. When a market is trending strong, we should see larger candles with small wicks. Once we start seeing smaller candles, this signifies a possible indecisive market with no clear direction. We also can get an idea about the momentum of the market or current move based on the candle size, and we'll look at that right now. All right. So when we look at the market one candle at a time, as we look at each candle from each green arrow, starting here, so pointing at the low of each candle, we notice that no candle has closed below the low of any other previous candle. So therefore you could see this low, this low, this low, this low, and this low. The market never closed below any of these candle lows. So again, if you look at the market candle by candle and then expand on that, there should be no reason for you to trade to the downside. You should never be looking to trade to the downside because the market has not violated any of these previous candle lows. All right. So if I'm looking for a short entry, then I'd like to see a candle close below a previous candle low, as this would indicate that the momentum in the market is weakening and may turn bearish. The rejection candle now up here, you can see the rejection candle, which is at the resistance level here. Once you have a resistance level with a big rejection like this, that's a strong indication that the market may change direction. All right, the rejection candle gives me a strong clue that the bullish momentum is weakening and the bears are getting stronger. So we don't want to enter a short position while bulls are in control, right? And so we need a clue that they're losing control. The first sign of a clue is that you had this big rejection. All right, that showed that the bulls were unable to sustain this move, and the bears pushed it right back down and stayed below resistance. And staying below resistance again is another big sign. The market was unable to break resistance. So we're never going to go short on a green candle, because who's in control when we have a green candle? The bulls are, so we don't want to trade against strength. All right, so we need something to show us that the bears have finally started to jump into the market and take control. But we looked at the market one candle at a time and we could see exactly what it's doing. All right, and then finally you have the previous low at this level is broken. This level right here, that's the previous low. First, this was the level. So let's go back. You could see this was our short level entry because that was the previous low. We needed a candle to close below that. But then the market made another candle with the low that was higher than this previous level. So this is going to be the point where we want to look to get into the market or look for a close below that level before we even think about trading. So this is the first candle to violate a previous low of another candle. This signifies possible trend reversal to the downside. The violation supports our short trade entry of the pin bar rejection. So we were closing this pin bar, we were trading this pin bar rejection here. We want to put our entry below the low of that pin bar, and we need to close below that. But as the market made a new candle, it never violated the high here, and it never violated the low yet, but it made a new high. So we put our entry here now. All right, and we walked this just like a zone walk. All right, and I showed you how to walk wick trades also. And then you can see what happens here. The market stops breaking previous highs. So it was breaking previous highs. It wasn't breaking previous lows. It was breaking previous highs. And then finally it stops. Now the market's breaking previous lows as the market moves lower. You can see it breaking previous lows. Boom, boom, boom. Broke this low, this and this. And then no high is broken as that takes place. So the market forms indecision and doesn't break the previous low. It formed an indecision candle and didn't break that previous low yet. And then you have resistance here. So let's back up. You can see this is where we are. And then now we're up here. The market violates that previous low. This was the low we were looking to violate. And you can see that line here. That's why you box this market in. It violated that level, and there you go. Once the market starts breaking the previous low, you'll notice that it never broke a previous high again for a while. We can use this info to help us with entries and stop losses. We'll look at this concept when we put it all together, but get yourself used to looking at each candle and analyzing the market. Again, this is not 100% guarantee at all times, but just another clue to help us with our probabilities. All right, so that's going to conclude this unit. All right, but we touched on some very important concepts that you need to start using in your trading plan to increase your probabilities. From here, we'll go to the support and resistance module, and we have answered questions such as what, when, and how, but we need to know where. Okay, so we've answered these questions as what, when, and how, but now we need to know where. The next module should answer the where for you, and it should all start coming together. The concepts will again all be covered in our final module. Then we'll put it all together, and from there you should be on your way to understanding how to set yourself up in a high probability opportunity. So no matter how much info you learn here, it will still be a battle, as we need to defeat the mental aspect of trading, which is going to be a very tough part of your trading. All right, so we'll discuss the mental side after we put it all together, and then you'll be mentally prepared and technically sound. So see you in the next module.